Probably two more cuts, and three is very much on the table. In their heart of hearts, they'd love to already be at 2%, but
All right, so today I'm joined by Robert Embree, a senior economist and vice president at Rosenberg Research. Robert, thanks so much for coming on the show today.
thanks for having me, Mark.
So we got the unemployment numbers this morning, came in at 7.1%, 60,000 jobs added. Are we out of the woods?
Probably not. One thing that we've seen all year, particularly over the last 6 months, is the incredible volatility in these month-to-month employment numbers. There's been a huge amount of churn. There's been a lot of variation at the sector level. So we lost over 100,000 jobs in the two previous months, which means that the combined 3-month sort of running total is still negative 46K. And that's actually the largest 3-month drop since January 2021, back during the pandemic. And so, hey, if we see another month like that next month, then maybe we can talk about being out of the woods. But we're still skeptical. I do think that the most likely consequence of this is that an October pause at the next Bank of Canada meeting is a lot more likely now because of this. But that doesn't mean that the rate cutting cycle is over. I think, the Bank of Canada is more of a data driven kind of wait and see attitude.
So you think that they'll kind of take a wait and see approach and maybe leave them some more firepower for December's announcement?
Yeah. So a couple weeks from now, we'll get the new CPI numbers. And obviously for the bank, that's the other piece of the puzzle. But I think it's very likely there will be a rate cut in either October or December. It's just sort of hard to predict exactly the timing of these things. But we certainly don't think that the rate cutting cycle is over and done with.
So let me ask, and obviously everything comes with the caveat that no one has a crystal ball. Where do you see the neutral rate heading? Or where do you see the policy rate, I suppose, heading over the next year or so?
Probably two more cuts. And three is very much on the table. I mean, if you look at market pricing expectations, it's pretty much most people think one and maybe two would be possible. Given the, economic headwinds that the United States is heading into and how much that affects Canada, and given how oil prices are range bound and, West Texas Intermediate was below $60 today as of this taping, it's tough to see the current rate doing. We see a lot of the inflation risk sort of hitting the wall in the labor market, even though unemployment is 7.1% and was a little better than expected today. That's still quite bad, actually. That's still well above what we call the neutral rate of unemployment, which is the sort of long run average rate at which you wouldn't expect to see disequilibrium. That rate is more like 5.5 to 5.7%. And so we still have a ton of slack in the labor market.
Youth employment over 10%, sitting at 2010 levels, I think it is.
Yeah, close to 15. Close to 15 now.
Isn't that often seen as the canary in the coal mine for an economy?
It can be, absolutely. If you think about what employers do before they start firing people, the first thing that they'll do is stop hiring new people, right? And so we've seen already in the last year in both Canada and the US, the beginnings of this sort of no hire, no fire economy where the labor market is much less dynamic. People used to talk about quitting their job, and now people are hugging their job. And so that affects younger people and job switchers first. And we're seeing that. And people who are currently unemployed, we're seeing average, unemployment duration go up. So those are the things you would expect to happen first. We haven't seen huge layoff rates, but what's important to understand is unemployment can keep going up even without large layoffs. Just, new people are entering the labor force at a faster rate than the economy is creating jobs. We've created very few total jobs over the last 12 months. Unemployment growth's running around 1%-ish, depending on how you calculate it. That's much below the long-term average, and it's much below sort of the break-even rate. And that's why unemployment's been going up.
Now, let me ask you the cause of all these unemployment numbers. Is it just the tariffs alone?
The tariffs are a major source, and the slowdown in the US that the tariffs have contributed to is also a major source. Some of it that I mentioned before is energy prices, right? Normally, if oil's $90 a barrel, that's a huge source of employment gains, particularly in Western Canada. That's not really happening right now. But there's also a lot of weakness in the domestic economy at a structural level, right? The way I like to explain it is Canada has two problems at the same time right now. We have a structural problem and we have a cyclical problem. So structural problem is we just have very low potential growth rate, very low rates of investment, very low rates of productivity growth, not enough investment in new technologies in R&D, and relatively low rates of capital formation. But then on top of that, we're also even below sort of our normal potential growth rate, right? So we have two problems at the same time, and that's what's going on.
So while we're talking about causes, let me ask you about the renewal wave and current consumer debt loads. As I know for the past year or so, Rosenberg Research has even talked about this, that the amount of money coming out of the economy due to the debt loads, that's going to put downward pressure on economic growth. Is that still a worry? Are we still being compounded with that?
It can be. Canada's household debt levels are a little on the higher side, right? And we just got new numbers actually out of the US looking at their credit growth number. The credit levels can sometimes reflect economic strength rather than weakness, right? Like sometimes when debt levels are going up, it can be because it's bad times and people are borrowing, but sometimes it can be people see their incomes rising in the future. They're very optimistic about prices. And so we're not really seeing that, right? People don't have, if you look at indices of sentiment and people's expectations about the future, they're certainly not as robust as they were a couple of years ago. So that's not what's causing rising debt levels. It's much more sort of borrowing at a more basic level.
But the effects of the debt levels, is that still a concern that a lot more money is going to be going to the banks and once everyone renews at these higher rates?
Absolutely. So we have sort of a bit of a mortgage renewal cliff coming starting this year, next year, because unlike the United States, where it's much more common to have a 25-year or a 30-year mortgage, in Canada, it's much more common to have a 3-year or a 5-year mortgage. And so many people refinanced in 2020 and 2021 at these ultra low rates, as I'm sure your viewers already know, that now is leading to this big cliff. The Bank of Canada obviously is very much aware of this, right? And it's one of the reasons why, all other things being equal, they would actually love to be cutting rates right now. But inflation has been just sticky enough and uncertainty has been just high enough around that it's really been slowing them down. I think in their heart of hearts, they'd love to already be at 2%, but it just hasn't been possible with the way the CPI numbers came in all year.
So to a certain extent, this economic slowdown is convenient for the renewal wave. If
For borrowers,
the central
absolutely.
bank,
For borrowers, 100%.
yeah. So, and I think a lot of my viewers have made this point, and I tend to agree with it, that a lot of this, the economic uncertainty that we're seeing and a lot of the fallout from it is going to be blamed on these tariffs. But a lot of these problems were building anyway over the past, I don't know, I guess you can trace it back to '08, even before. But like really, this was a long time coming, a lot of these problems.
It's true to some extent.
Yeah.
The tariffs and the large slowdown in oil prices this year are both pretty exogenous. And I can absolutely imagine a scenario where, let's imagine, a conventional Republican wins the election and just puts in totally business as usual policies, no tariffs, AI demand is humming, oil would be, 70, 68 instead of 60. And there would be much higher consumer sentiment and people would be a lot less on edge than they are now. In all those scenarios, Canada might be humming along just fine for a few more years. So I take your point about building up consumer levels. Certainly, I think that Canada was due for corrections in many parts of the housing market specifically. because of, sort of post-COVID overbuilding in condo markets and a lot of these like really localized trends. But I don't know necessarily would think that there's such a thing as an inevitable recession.
Speaking of the housing market, actually, David Rosenberg the other day said housing may be in the penalty box from a GDP standpoint for quite a long period to come. So, in your research and how you're looking at it, is the market coming back anytime soon, or where do you guys where do you stand on the real estate?
Well, these things are all connected, of course. A lot depends on how quickly the government can cut rates. This jobs report, if I'm remembering my numbers correctly, showed construction shedding 8,000 jobs at a time when the rest of the economy is adding 68,000, right? And so the housing market has been definitely an overhang from an employment perspective. And there's still new supply coming online. A lot of the new supply coming online has been sort of purchased or spoken for, but certainly not all of it. And if inflation is sticky enough over the next 3 months, the Bank of Canada drags its feet. We only get to maybe one more rate cut by, let's say, next June. I can imagine that scenario. I can see much deeper house price declines ahead in that scenario. So that's certainly a live prospect, particularly in some of the frothier markets, in some of the condo markets in Toronto, Vancouver, right? It's certainly not, Canada actually, we talk about the housing market, but
Yeah,
really it's a series of regional housing markets. Again, I don't have to tell you, this
yeah.
as well as anybody.
Where the prices went up the most, I think, is where we're seeing the biggest
Yeah.
declines. Whoever was the frothiest during the bubble, it's going to pop the hardest. Yeah.
Yeah.
So while I know that you actually specialize in geopolitical risk, or at least it's one of your focuses. What do you make of these comments coming from Howard Lutnick on the auto industry? And I look at those and I see Trump's the way he put it a few days ago that we're just in competition for each other. We kind of want our auto manufacturing back. I think there's this idea when these tariffs came down that somehow it was going to work out, but it doesn't look to me as though they're budging. This does actually look like a absolute policy shift on the part of the U.S. that isn't going away. What's your read?
Well, I have a couple comments. First of all, my preferred way to interpret something like a comment that Lutnick is making, or when Besant or Hassett or some other administration official says something, is that the Trump administration almost in an unusual way conducts its policy debates in public. Like in a typical administration, they would have a cabinet meeting with the president and all sort of do it in behind closed doors. In this administration, they sort of do it on TV, and Trump watches. So in other words, what that means is that's Lutnick's opinion that may or may not be administration policy. It could be, but also it might not be. And so that's one thing to think about. That said, I do think in this case that's the direction Trump's leaning right now. And the key for Canada is honestly CUSMA renegotiation, which will be happening over the next 6 to 9 months, uh, is so important and affects so many more jobs than just the auto sector jobs that if we have to eat the harm of those auto sector tariffs to get CUSMA renegotiated on current terms, as bad and unfair a deal as that is, that might be the best that we can do. Right. And it would be very, very unpopular and people would be very unhappy with it, but we may have to consider that possibility. And that's what every other country, Japan had to accept 15% tariffs. The EU had to accept 15% tariffs. These are all professional trade negotiators who are doing these deals. They understand this might be Trump's best offer. The last point that I would make, and this is, today we're seeing this is Friday, October 10th, as of this recording. And Donald Trump is threatening new tariffs on China. And so the point I would make to people is I've seen a lot of press coverage in the last 6 months of people imagining like, how will the tariff file end? Like, how will we get to a new status quo where there's no more tariff threats? I don't know that that's going to happen as long as Donald Trump is president. So Canadians need to prepare for a world of heightened uncertainty, heightened trade tensions on an ongoing basis, even if we do renegotiate CUSMA. It's auto today. It could be something else tomorrow, right? I don't believe that the lumber file has completely gone away. I can see that coming back in a couple of years. These things are a fact of life as long as Donald Trump's in the White House.
Kind of made that point, I think, a few times on the channel as well, that as these negotiations near, he's not going to negotiate quietly. Expect to be on Twitter, on True Social. And just that alone, I think the uncertainty could hold back a lot of investment just from that
Absolutely.
act, let alone the thing.
I mean, it does so many different things. First of all, even the threat of tariffs without the reality of tariff at the margin will cause firms to relocate. If it's a coin toss between Canada and the United States and everything else is equal, they'll locate in the United States. The flip side, though, is that if we can get CUSMA renegotiated, Canada's not the only country this is happening to. It's happening to every country in the whole world. And so, as frustrated as Canadians are, we actually face a lower effective tariff rate right now than Europe, than the United Kingdom, than Japan. And so there's a sense, and it seems strange, but there's a sense in which we could gain some investment from having better trade access to the United States than other countries. And I wouldn't be surprised to hear Mark Carney start making that argument about 6 months from now.
Fascinating. Yeah. Yeah, I like that point. Speaking of Carney, I'm just got one more question for you because I know your time's limited. What do you think? What are the options for the government? I've heard you say before that we can do a lot of things, but it doesn't provide an immediate fix. They can't juice the economy in 1 month's time.
Right.
So kind of where do we stand on that? Because we're hearing more and more announcements every couple of weeks.
Yep. They're certainly doing a lot of things, and it's important to break these things into two categories. The Carney government is thinking seriously about a lot of long overdue structural reforms. They're looking at interprovincial trade barriers. They're looking at energy projects and east-west pipelines and permit approvals. And that's all great stuff. That helps with the sort of structural growth problem I was talking about. But you're not going to really see any growth effects from those things until a year from now at the earliest, maybe 2 or 3 years from now for some of this. These are slow moving things. However, I think we're also seeing some fiscal expansion. So they're stepping up a lot of military spending. I expect to see some more infrastructure spending in the fall budget now that they're switching to fall budgets. The Parliamentary Budget Office was talking in terms of like a maybe $68 billion deficit, but that doesn't include a lot of the additional spending that we think they're planning on doing. That's just sort of what's official right now. So we're looking at an $80 to $90 billion deficit. That would be my expectation. And that will have a stimulative effect to some extent, right? Some of that is just good old fashioned Keynesian spending, and that given our slow growth rate right now, that probably is desirable economic policy. The question is, how long do you want to do that for?
Yeah. Yeah, and I think that's a good point because right now we do have the fiscal space. We're not obviously where we were pre-COVID, but we're also not sitting at 120 to GDP
Oh,
either.
no.
So there is room, but I don't know how long there's room to sustain that type of investment.
Yeah.
Yeah.
And so the Carney government is going to try to change the budget process. They're going to have a capital budget and an operating budget to try to make it a little clearer about, oh, well, we might be borrowing, but we're doing it for these long-term projects.
Right.
Now, how much they're going to take advantage of those categories, like how credible that will really be, I think remains to be seen. But potentially it's a useful idea if it facilitates more true infrastructure spending. I think that could have very good consequences.
True, as you say, Keynesianism, the way he envisioned, the way it's supposed to work with
Exactly.
cyclical downturns. Yeah, yeah, no, I agree. Okay, Robert Embree, Vice President of Rosenberg Research and Senior Economist, thank you so much for being on the show today. I think this went really well. I think that was a lot of great information.
Absolutely. Thank you so much, Mark.
Thanks, Robert.